Hey, everybody. Welcome to the Practical Founders Podcast, where every week we hear an amazing story from a serious founder who built a valuable software company and did it without big funding. I'm your host, Greg Head, and this week my guest is Bill Spruill, the former CEO and president and co-founder of Global Data Consortium, GDC, as he calls it, identity verification software, accessing data to help e-commerce providers and banks prevent fraud. So he served the fintech community, but had a software product that aggregated data and helped verify identities of people logging into banking and purchasing things online. This is a practical founder story through and through, but Bill sold his company in 2022 for $300 million to a strategic buyer. It's an amazing story about how he sold that. It grew slowly, picked up steam, and then accelerated before they bought the company. It's a practical founder success story with just a little funding in there and an amazing founder, Bill Spruill. I know you'll love the story. And we're live with Bill Spruill. Hey, Bill, good to see you.
Great to see you again.
Where are you today in the world? I know you're a traveler now that you're a former CEO and founder and sold your company, but are you in your home turf there in North Carolina?
I am. I'm actually in my office here in downtown Raleigh. So it's good to actually be in Raleigh for a bit. I spend about a third of my time here in Raleigh, a third of my time out on the North Carolina coast, and a third of my time rest of the world. So life has changed a little bit on that.
So I guess that's the thing that says when you sell your company and you sold it for a massive amount, we're going to talk about this, and cashed out, literally cash, not this private equity game. You know, what happens afterwards? It's been a couple of years. Are you settling into your new routine? A little office time, a little, by the short time, a little world traveling time, and, all your initiatives?
100%. So what happens afterwards for a lot of us is, initially there's confusion because you're no longer in charge of your business anymore. And, oh, by the way, you have this bank account that has swelled tremendously all of a sudden. So then it's, what do you do? And what do you do, with your spouse? What do you do with your family? What do you do with your community? And, that took me roughly 2 years to really get settled into. But I started off starting a family office that I call Second Foundation.
Yeah.
And I've got a team of 5 people here who work Monday through Friday and focus on a couple of key initiatives that we have. And I spend my time working with that team to actually execute on those initiatives when I'm not traveling the world, seeing new places, visiting friends, and generally enjoying life.
Yeah, good for you. Well, you had a massive exit, one of the biggest ones we've ever covered here on the Practical Founders podcast here. And it just goes to show practical founders who bootstrap it and grit their teeth and sell their companies often get in the investment game to help the next generation along. There's a little irony there. We'll talk about that. Let's just start with where your company ended up. It was Global Data Consortium, and you were a co-founder and president in charge. Not technically, you didn't want to call yourself a CEO, but you were the CEO there. And you sold it to the London Stock Exchange in 2022. Is that right?
That's correct. We closed the deal in 22.
Okay. And can you say how much you sold it for? Let's just start there. Then we'll go down the hill from there.
All of the governors are off now, without a doubt on that. But we sold it for $300 million US.
$300 million. And you had just a little bit of funding in there. You bootstrapped this. This wasn't a classic VC funded story where the founders get a little piece of it. You and a co-founder and your team members, let's say, won a big cash prize. It was a cash out exit by the London Stock Exchange.
It was. We had only taken roughly $5 million in actual strategic investment. And then other than that, we only had friends and family and our own blood, sweat, and tears invested in the business.
Yes. Well, congratulations here. What is Global Data Consortium, GDC, as you call it?
Sure.
Let's talk about what the heck it is. It's a little different kind of tech business that's software powered.
Yeah, ultimately, I'll talk about what it became and then work backwards to what it was when we started it, because those two things were slightly different.
Thanks for for revealing that. Most people don't admit that.
So ultimately, what we were was a know your customer verification business that was able to provide consumer, meaning personal verification, PII, personal information for roughly 70 countries around the world. So whether you were a consumer online transacting from Japan, Brazil, Europe, and I say Europe, France, Germany, etc., we could actually take the PII you input into a system and validate that against independent third party databases to say
Yeah.
whether or not that information was actually accurate, which would allow for an organization, a bank or a fintech to determine whether or not you were real or not real. KYC is what the
Yeah.
process is known as.
Yeah. To fintech. But we would say identity verification. If I'm in France trying to order something online at let's say a US e-commerce site, right? And I put in my address and I say, ship it to me or something. Almost every storefront banking has double, triple extra verification to prevent fraud. And you're part of that process. So you would API out to your software and your data, and you would give a thumbs up or a thumbs down or some kind of grade on, is this the real person kind of thing?
Absolutely. In fact, you did a much better job of describing my business. I should have hired you on the Marcom side.
I call that Greg GPT. I don't charge for it right now, but someday I might. So, yeah. I'm just trying to bring it down to our practical SaaS founders out there. So it's software powered and it's an API plug-in, let's say, a system that's in the back, but it's got a lot of data that you're playing with. You're playing data games, right? Getting validated data, building, I don't know, maybe you're intermediating with other data partners or something like that. But
that was our secret sauce, actually, was we built a very robust network of data partners around the planet. And those data partners were specialists on data, identity data in their own home country or region. And we didn't become the specialists, the global specialists. We became the specialists in bringing together those individual specialists all around the globe, tying them together into a single API, and then being able to serve that up to our customers on a API instantaneous basis.
Yeah. Yeah. So one API. I mean, did you have big customers like big banks? And I don't know, can you talk about these customers?
Sure. Absolutely. So our customers ultimately were organizations like Stripe, Mercado Libre, DHL e-commerce, Remitly, MasterCard, and other organizations like that, PayPal as well.
So you took your scrappy startup and grew it up, but eventually you were doing, let's say, multi-million-dollar deals or, enterprise deals with these financial providers that needed another layer or maybe to make their stuff easier to plug in and verify personal information.
Absolutely. That was our big model, was we were the company that could bring you the globe. And many of our competitors were not global in nature. And so we were a very unique organization for many of our customers on the other side of that.
And briefly, London Stock Exchange, it's not just the stock exchange, just like the New York Stock Exchange. They also have money spit out of it that they buy companies and pile it up and get into the finance game where they see opportunities. They wanted to add that to their portfolio of technologies, I guess.
They did. The division that we were actually ultimately a part of was a part of a company called Refinitiv that they had already acquired some time before. And Refinitiv is known for also providing identity verification in terms of a product called WorldCheck. So our product marries up against WorldCheck very nicely. So for LSEG, London Stock Exchange Group, this was actually a really good deal to help them continue to expand their platform for international identity verification.
Okay. And how many employees did you have when the company was sold?
So, we had roughly 30 people between full-time employees and contract employees. We had 30 people. And that was actually a high watermark for our organization. We grew into that 30 person shop.
Yeah. Yes. And you grew over a period of time. We'll talk about your practical founder journey there. How much revenue were you doing to sell a company for $300 million cash?
So at the period of that transaction, we were doing between 20 and $25 million in revenue.
Yeah, so this was more than a 10 times exit, right? So 2022, that was a little heyday that was going on there. Everything was bubbly. And I guess you chose wisely. You
We
had some good timing there. You were growing and successful. And presumably you had multiple folks that wanted to acquire you, and you could say no, and you played them off each other. And I guess we'll get through that as well. So congratulations on that. What an amazing story from North Carolina. Never would have heard about it. Doesn't make the big news, even though I'm very confident in saying this, Bill, between you and your co-founder and your team and your practical investors in there, you all made more money than 90% of the VC funded founders that ever raised money and exited. They really don't make that much money in the end. You gotta you gotta be a very rare one to end up with hundreds of millions, for the founders and employees in the end. So congratulations.
Thank you. It was a great outcome for everyone. And, the number of people who helped contribute to it, huge. It was the team. It was our friends and family. It was our spouses. It was by no means a singular effort by any length of the imagination.
Of course. Yeah. So we're going to get the story from you, but I know it was a team. What did it feel like to announce to employees and whatever, your brother-in-law or whatever, who sent you a check, these friends and family, that the prize is going to be bigger than they expected?
So the great story behind that, so the easy answer to your question was it felt like being Santa Claus. But the great story behind it was we signed the initial LOI to sell the business or to have them acquire the business in November of 21. Late November of 21, we signed the LOI.
Right.
And we had to actually keep it under wraps, complete wraps, until it was ready to close in May. And the thought was it was going to close closer to March, but due to some compliance regulatory items, it dragged. And we had to keep this massive secret from the company, from the team, which was really, really hard. Very few people knew within the organization. We were very much a transparent organization. So this was not something that was normal for us to do. But then when we actually had the team all hands meeting where we brought everyone in to make the announcement, it was like a regular board meeting that we brought everybody together for. They assumed it was all going to be just normal news that day. And then we dropped the bombshell that, hey, we're selling the business. And I remember one of our key architects, the reaction on his face was amazing. He jumped up, ran out of the room, disappeared for probably 10, 15 minutes, and then came back into the room. And you knew he had gone. He had looked up probably how much he owned and realized the math, what his personal outcome was with the business. And it was a great feeling. It was a great, great day. It was a mixed emotional day because at that point, this is no longer, our business. We were moving to another phase of another chapter of life. But it was a great point all the way around.
So this wasn't a private equity exit where you sell a minority majority, but you still, run the business and the other shoe doesn't drop for a while, the second bite of the apple. You sold it in an all cash deal. Were you out of the business pretty quickly?
I was. Both my co-founder and I really stepped out of the business very quickly. Our CTO and my CFO took over operations and we stayed on as consultants for a very, very short period of time to do the right thing. But there was, after about 4 months, I think they said, they approached and said, hey, Bill, we don't really need you anymore. Would you be good with ending the consulting arrangement? And I said, yeah, no problem, guys. That's easy, please.
Wow. Well, we'll talk a little bit about all the excitement of that. Again, congratulations here. Is this what you were expecting when you created this company? I know you're an older founder. You had a few runs at it before in North Carolina, a couple acquisitions you'd lived through. But did you start this company expecting to build it towards 25 million and sell it for a big price?
Not at all. Not at all. I remember early days, if we go back and pull up any of the early day PowerPoints, my co-founder and I really were thinking that we were going to sell this business for probably $20 million.
Hmm.
and each of us walk away with maybe, $4 or $5 million.
Yay.
And, you know, yay. We had no envisioning that we were actually going to end up with a business that was pushing 20 million plus in revenue and growing at over 100% a year and
Oh
sell
my
that
gosh.
business that way.
So you kind of, you went slowly for a while, zigged and zagged, and then all of a sudden it took off. Is it one of those?
I dare say about the all of a sudden it took off, but it most certainly was. We spent about the first 5 years of the business, in the desert, wandering around and, trying to figure out survival. When we started the
Right.
business, going back to a point we wanted to make earlier in the podcast, when we started the business, we started it as an address validation business, and we thought we were going to license raw data to people. And then
You would get the data and people would buy the data from you and
exactly.
you'd manage the data and validate and, you'd have the best data. Yeah.
Exactly. We would have the best data set, and our customers were going to be MasterCard, Visa, and organizations that just wanted to ingest the data. They didn't
Mhm.
want APIs or any of that other stuff. And then GDPR kicked in, which most people know as data
Uh-huh.
privacy regulations. That
Yeah.
universe kicked in. And we began to have to pivot the business. So we pivoted into being a address validation business, leveraging web services, that API model. And then we pivoted again into the business that became our identity verification KYC business. And so there was a double pivot inside of that entire
Right.
span of time.
So you and Charles said, let's go get into this data validation, verification, some kind of business like that. And it took you like 5 years to figure out that it was what the business ended up. I mean, and you didn't raise a lot of funding. Was this your own funding? And I don't know, go consult, for a day job and fill in the blanks and, sell what you can and, see if it works. One of these, running around, as you say, in the desert, the experiments.
Absolutely. Charles had a family and had not had a prior exit similar to myself. So we had to find him a gig, a consulting gig that could cover the bases for, especially around healthcare and those items.
Ah,
So we did that, and that worked out really well for
okay.
all parties involved. The other side was gambling we were going to fail, and they would actually get to keep Charles, and we were gambling that we would succeed and that Charles would ultimately have to quit that gig.
Okay.
We won in that particular exercise. And then additionally, we did other consulting and other experiments until we found exactly the right secret sauce with the customer, our initial customer set. And once that part happened, then the cascade process actually really began. But it was a tough.
Okay.
We took out an SBA loan,
Yeah.
and at one point in time, both of our houses were on the line from a founder's
Mm,
perspective. And
yeah.
never 100% confident that our spouses knew fully how much on the limb we were, but we were confident
Mm.
that we would figure it out. And we knew we would never default on the loan between the two of us. We always knew we were highly employable. And our worst case scenario was we would have to go get a job. So we were making big bets, but we had a high degree of confidence around our ability to execute around those bets.
And so your co-founder Charles was the technical guy, I guess, building first platforms and data, management and all that. And you were, let's say, the sales guys, business development, and right, getting meetings and putting
100%.
together contracts and seeing if they'd pay and making all that kind of stuff up. So practical founders are used to playing this game. Is it this? Is it this? Is it this? Is it this? What was it that you saw that made it say, we finally, let's say, cracked the code or found product market fit or whatever you want to say? We see our way and we're going to stop doing that and we're going to go this way. How did that come about?
Well, there was a low point in the business where we were just struggling with, are we going to, why are we
Yes.
doing this? Are we going to make it? Or do we have enough revenue? And we actually stepped back. Our then head of sales, biz dev, had to step away from the business because we weren't making enough to pay his salary and he was going in the hole. And so we were kind of, back to us doing kind of primary sales motion. And we stepped back and said, we're going to do something very simple. We're going to focus on 10% growth every month. And at that
Okay.
point in time, 10% wasn't going to be that, it wasn't that big a number. Our revenue was just that lower threshold. We said, we're going to move this needle 10% every month. And then you get into the power of compounding. And every month we moved it 10%, and we would celebrate that amongst ourselves. And we would
Small win.
keep small wins. Exactly. And we kept moving that needle 10%, 10%, 10%. And eventually that number got to be a very sizable number where, we cracked
Well,
through,
that adds up, of course.
you
Yeah.
know, I remember when we passed the 5 million in revenue marker and we paid off all of our debt. And that was actually a very interesting moment in time because we said, well, we're profitable. We're actually making money. We're profitable and we're putting money in the bank. And we kept growing at 10%. And then that really unleashed the ability to accelerate our growth at that point in time.
Did you just keep trying to get deals and then you found GDPR pushed you out of the address game and you had to run to something else and it kind of worked? You pivoted?
It did. It did. We
Okay.
ran towards identity, leveraging the same data providers that provided
I
the
see.
data for the address. We were able to use those providers to provide data for identity. So we didn't have to negotiate net new relationships.
Oh,
And it was really, we were able to charge more for identity verification. We were able to get as much as $1 to $2 per transaction.
wow.
Whereas in address verification, we were only getting 5 cents at the most for a
Wow.
transaction. So our profit margins also increased tremendously in that exercise.
How many years was it, the wandering in the desert? Just
Uh,
so people get a perspective.
It was 5 years. It was a
Five
solid
years.
5 years that we were wandering around in the desert before we really got that traction. And we had some great people working with us even during that 5 years. But we also had a lot of turnover along the way because those people had to leave and go and try to actually make enough money to eat and prosper.
Yeah,
So we did turn over some team members along the way,
I'm sure.
but we allowed people who left to retain their equity. And that was part of our mission
Oh,
plan.
nice of you. Yeah, that's
Uh,
very generous.
we didn't claw it back, and we
Yeah.
could have easily clawed it back and done that, but we wanted people to be rewarded if we were successful along the path.
Yeah, because you're making a promise. Come along with me, invest your time and energies, and maybe your own money in this thing that you're sacrificing your opportunity cost. And you're in you're not in New York or Silicon Valley. You're in Raleigh, North Carolina. You know these people. You see them at
Yes.
the grocery store and things like that. So I bet that felt good when you got to the other side of that. Did you try to raise funding? There's a little bit of funding in Raleigh and VC funding, and you had a story. And did you try, or were you never go in that direction?
We did try. We actually tried locally. We tried nationally to
Mm,
raise funds. We thought we had a great story around the business and around our backgrounds. Both of us
yeah,
were experienced. We had
yeah.
worked in growth companies before. We've been part of acquisitions and actually helped to
Check,
negotiate
check, check.
acquisitions.
Yeah, right. Yeah,
There was nothing that in theory made us unfundable, or at least so we thought. But time and time again, we would get you are not a venture backable business. You are not a fundable business. You need to grow more. We got a lot of
yeah,
reasons. And what was always interesting is every time we would get one of those reasons, we'd go back and grow more, or we would do the thing
yeah,
and then come
yeah.
back. And then
Yeah.
we still
Classic.
weren't there.
Yeah.
We were never quite good enough.
And this is even after you discover the identity game where the model was proven and it was working, and then you get profitable and all of that. Wow.
Yep.
Why do you think that is, Bill?
Myriad of reasons. Personally, I really narrowed it down to two. A venture VC who was a really good friend of mine actually told me at one point I was far too practical
Okay.
founder,
Mhm.
and I was going to grow a real business, and that meant they would not get enough of a bite in the
Yeah, yeah.
business to
It's not
make it.
crazy enough.
Yeah, it wasn't going to be what they were looking for. And then, frankly, I think the other thing that I found is that I was unusual in the funding exercise. I was an older founder and, I was Black. And so when you look at the statistics around funding, especially during that period of time, it was clear that funding that type of
Mm.
founder from a venture bias perspective was a very uncommon exercise. So we're in North Carolina. We, older, I'm Black. Why would we invest in an organization like that? And I say thank you for
Yeah.
everyone who actually told us no now. So,
Yeah. Right. That's my next question. Are you grateful that you didn't get on the drugs, the crazy funding drugs that you can't really get off of? You procrastinated it successfully for years for your own reasons and other reasons. Do you feel lucky that you didn't get
every
too
day.
much funding too early? Yeah.
Every
Okay.
day, because it led to a different transformational exercise. It allowed for us really the optionality on decision making on the deal, because it's possible that had we taken funding from traditional venture capital, we would have needed to try and sell for a much larger number to get to the same type of outcome.
Right.
And
Absolutely. Right. That's
it,
simple math, right? Yes. Mhm.
Exactly, exactly. I tell people often that much better to have 30% of a $300 million outcome than 5% of $1 billion outcome.
Yeah, so that's the dilution math, and the opposite is you should have it's better to have a smaller piece of a much bigger pie, right? That's the VC saying, if you have 5% of this, and if it sells for billions, then look at what you could do. But it isn't the dilution that's the problem; it's the odds of selling for billions, which are
Exactly.
really quite low, And you played your game, successfully. We'll talk about how you turned it up to get a great exit, but yeah, it's not the dilution so much. And you took a little dilution. As you grew, you took, as you mentioned, a little bit of investment from a strategic partner. Is that one of your data providers or somebody like that?
So they were a partner, a customer partner.
Oh, I see.
And the story behind that funding, there's actually two parts to this story that I think I'll share that I'm not sure that I've ever shared elsewhere, at least one part of that. So one is they were a strategic, and we always knew we were going to be acquired by a strategic. That was part of our playbook. We just didn't know who it might be.
Right.
And so, we had originally started the strategic funding path working with Experian. And we had gotten all the way to the point, definitive docs and final sign off. And they
For
actually,
funding.
yeah,
Yeah.
for the funding round, the $5 million.
Hmm.
And they actually retraded on us. They actually came back and changed terms at the last minute, lowered the amount, changed some things.
We're big, you're small. Here's the deal. Here's the new price. Sorry.
And you should just be happy that we're investing and we can do all these wonderful things for you. And we just basically said, no, we're not going to do that deal. And I remember sitting in our office, my CFO and my co-founder, and we were being very mindfully conscious to say we were going to walk away from this transaction. My CFO couldn't believe we were going to do it. And we had tried to walk away from it multiple times, but this was the straw that broke the camel's back.
Yeah.
And so
You walked away from it because it wasn't a good fit and they were playing games and they revealed their true selves.
Exactly.
And you were profitable and sustainable and you had a solid business and you didn't need their money. You didn't need it.
Did not need their money. And so then I reached out to my colleague at Refinitiv who had expressed an interest in funding. And we had said, no, we're dancing with these other people at the moment.
Yeah.
We can't talk to you about this right now. And reached out to him and told him, hey, we just walked away. Is there any interest? And he very succinctly said, we'll do the deal. Whatever, we'll do the deal. And they did. They actually did the deal. They did it in record time, 45 days, I think it was, from start to finish. That was a great exercise. So we were thrilled to have them in. But the other piece of this story was a number of our larger enterprise customers actually wouldn't commit to working with us without having venture funding. And it was so
Is that why you raised funding effectively? You didn't have to, but you did.
Yes, correct. Yeah. We didn't have venture funding, and they basically said that they were not as confident of our stability versus
that makes sense.
competition that
had
had
a lot.
funding. I don't know that it made sense. I kind of said, well, I'm profitable. They're not. Who's more likely to run out of money? Who's more likely to, fall apart versus, the profitable business, sustainable business, or the non-sustainable, unprofitable business?
This week's podcast is sponsored by my friends at Cypress Growth Capital. My favorite milestone for practical SaaS founders is after you've survived the first few crazy years and you have some repeatable sales and a growing team and perhaps a little profit showing up. You know you could grow faster with a little outside capital, but the thought of raising money from VCs would change your whole game. And we know VC funding is the most expensive growth capital on the planet. That's why so many practical SaaS founders I know have partnered with Cypress Growth Capital when they hit that predictable growth inflection point. For 15 years, Cypress has provided non-dilutive growth funding to bootstrapped SaaS founders, including many of the successful founders I've had on this podcast. They love practical founders. Cypress provides enough patient capital for you to invest in your growth without giving up any of your precious equity or having to guarantee a loan personally. Their investment team has people like you who have grown and sold successful software and technology companies, and their operational and entrepreneurial experience helps them give you strategic guidance at those key inflection points in your business. So go to cypressgrowthcapital.com/practical and learn more, and contact Cliff Centel at Cypress to see if there's a fit. Now back to our podcast. So let's just distinguish for our listeners here. Normally when you raise funding, it's from a fund, with investors and a professional investor. That's VCs and private equity, so forth. They're investors. They got money and you got the business. But a strategic was somebody you've been working to. They buy a lot of your stuff. And did you also think someday they could buy us and it's the beginning of this relationship dance that could turn into something? Was it intentional there? It eventually did.
It was intentional in terms of they were one of the potential buyers. We did a deal that allowed for them to have a look under the covers and to be a part of the business, but they didn't have the, control vectors to control the business. And we very deliberately wanted to make sure we maintained our independence so that we could maintain our independence around who that eventual acquirer may be.
How many potential acquirers in the space of all the customers in this data world and the fintech world and the data providers, right? It's a very active market, for acquisition. Are there a few or hundreds, or how many potential partners could there have been?
20, I would have put that number, 20 legitimate actors who could have afforded to buy us at the way we would want to have been purchased, during that period of time, because people were using venture dollars or, stock value. We could expand that list to maybe 40, but really I would tell you 20 serious potential buyers.
So in between this, wandering in the desert and selling it here, was it pretty steady improvement, enterprise sailing, improve your your competitive value, improve your contracts, improve your pitching, add a few more people, stay profitable? What did it look like in that climb up to the increasing growth rates? I guess 10% a month, by the way, is more than a doubling every year. So that's, it adds up here. So, but, you look at it in small chunks and it looks easier, maybe.
It does. And it did for the longest time. Yeah. So a lot of that work was block and tackling and then hiring the right people and slowly growing the business the right way. We ended up hiring a great CFO in the business who one of his metrics wasn't just to manage our books, but it was cost savings. And he actually went through every single one of our data provider contracts and found a significant amount of cost savings because we were being billed incorrectly. A lot of little things that added up to, $1 million savings for us in terms of our profit in the business. So he actually really worked well to increase the profitability of our business. So again, a great add on the team side that we were able.
Wait a minute, a CFO that did some detailed work there, Bill. So you had 30 people, and you had some pretty senior folks in there, not just the co-founders. You started to bring in some leaders who could get some stuff done. I guess, were they player coaches? They could do some of the work and, manage some of the people. This wasn't like, the
Everybody did
lots of
work.
levels,
Yeah, everybody in our organization did work. And that was something that was important. You didn't come in and just sit around and pontificate. That was the realm at best for Charles and myself. And we definitely didn't spend a ton of our time getting to do that either. So we brought in people like our GC, had taken a number of companies, our general counsel, had taken a number of companies public before. And he was working not because he had to work, but because he enjoyed the work. And his culture and his perspective, his background really fit our background. He was from the Midwest, and he just had just a solid background on that end. And why it mattered is because between him and our CFO, when we did the transaction, we didn't actually have to hire an investment banker. Most organizations hire an investment banker to negotiate the deal.
Yeah.
Well, my CFO was an ex-investment banker, and my GC had taken multiple companies public. So between the two of them, they knew everything that needed to be done. And we actually came out of this transaction with probably a record low legal bill from our corporate counsel because our CFO and GC knew exactly what to do. And they negotiated the best possible opportunity on the other side, such as no golden handcuffs, all of the things we needed to have. We took all the cash out of the business. So they covered all of the bases that we needed to have covered in the transaction. And it didn't cost me another 3% or 4% of the business to an investment banker, or 3% of the transaction. Yeah.
You weren't one of the cool kids to the VCs anywhere. And were you getting to be a pretty cool company to the practical, serious ones who looked at the business and said, man, you're doubling and you got big customers and you're profitable. And this is, it's a steamroller. And we want to, I'm a CFO. I want to dig in. The general counsel and, and other team members was this the kind of thing these practical people could see how valuable this was going to be?
Absolutely. And in fact, I'll tell you two different stories on that front around practical investors. Right after we closed our Series A with Refinitiv, and this was actually during COVID, the early part of COVID, we actually met a investor for a family office, the Robertson family office, and an investor named Brandon Wolf.
Yes.
And he and I took a walk, and we did a walk and talk meeting, COVID protocols. And I described the business to him, and we sat together, spent about an hour and a half. And, we ended that conversation with him wanting to invest, $1 million in the business. I said, well, we're not taking investment right now. We just closed our A. He was like, well, can you reopen the A? No. Yeah. How do we do? Yeah. But Brandon was both persistent and bringer of value that we actually maintained connection with him. Yeah. And what we ultimately were able to do was we were able to get them onto our cap table through some secondary transactions with employees who were leaving. Right. And so we actually got them onto our cap table without taking further dilution ourselves on that front. So we got him inside the fence.
Right. And then by being helpful and practical, and, he wasn't trying to get you on any crazy drugs there. He could see how valuable this business is. Brandon is the one who connected us, Brandon Wolf at Jordan Partners, who is a practical investor these days,
yes,
and practical founders, this kind of game there. So
I'll finish. I'll finish one other parallel to that though. But those guys also helped set us up for our Series B, which is ultimately what led to the acquisition. And I know we'll jump into that at some point in this. But
So your series, you thought about another round. Why did you think about a Series B round that eventually led to an acquisition?
So we were actually going to use the money to acquire some of our data partners to make their revenue part of our revenue, because we knew that arbitrage value would be pretty significant. And really, I'm a sci-fi, James Bond fan. And one of the things we had envisioned as our strategy was really our network of our partners becoming almost like Spectre for those who may actually know bond. But we were going to have this committee of international experts in data that were all tied into our business completely. And we were going to acquire a set of those as part of that exercise. So that's why we were going to raise our series.
Yeah, it's like literally thinking like your own investor and being acquiring and getting practical, like
vertical
a private equity would do to a lot of founders, but you could do that yourself, raising a little money. Did you talk to private equity investors that said we want to be the platform and acquire into this, and that's what you did? And
we actually talked to the Robertson family office, and they were ready to write that bigger check to support this because they had been exposed to the business already. So we had our B lined up at that point. We had a term sheet. We were ready to go. And we actually, the story is when we went to Refinitiv LSEG at that point to let them know we were going to launch our Series B and they could co-invest, they could do their pro rata. They leaned in and said, no, we want to lead the round.
We want it. Yeah.
We want it. We want that. We'll do that. And we were very adamant to say, nope, we want to maintain our independence. Having the Robertson family in helped us maintain our independence. Having more LSEG at that point in, not so much
their control. Yeah,
exactly. And so that's when they pushed back and said, no, we're going to insist and we'll block you from doing the raise if you don't let us lead it. And, we checked it out and we said, yes, they have the ability to block that, which, but that also revealed their colors. I had already proven in the past where I go back to Experian, where when people try to push me into a corner that way, I tend to respond a little bit differently. And so,
you seem like such a nice guy, Bill.
Yeah. And I told them, I said, no, what we will not do is actually do this round. We'll find another way to do it. And that our collaboration together, I was far less polite than I'm being on this particular podcast, but I was very clear that our collaboration was over. We wouldn't work with them as partners. We would conflict them out of any further discussions. And we were going to find our own way forward. And that's when business unit kicked in and said, hey, wait a minute, can we have a conversation? And that's when we sat down and ultimately they said, look, we'd like to acquire the business. How much? And
so that was, you got your Series A from another data provider that got acquired by the London Stock Exchange Group. And then you went there and they wanted to, I don't know who was pushing to take all of it and push harder. And they pushed you enough. And then it turned into an acquisition talk with the Refinitiv team owned by the London Stock Exchange here. So, and you didn't have M&A bankers. You're kind of looking at the landscape of all the strategic buyers, and there's Bill in the middle of this. You had some understanding of this game as well. So how did it go? Did they offer in the neighborhood of $300 million that you finally landed on?
Well, it was a very quick discussion, frankly. They asked how much. They asked what my number was. And we were doing our Series B valuation at $150 million. Yeah. And so I thought about what was the future value of the business. And I said, look, I'll double this number, 300 million to 300 million. And if you're willing to pay that, then I'm willing to sell it. Otherwise, I think I can do just fine.
We'll go that way. Yeah, we'll do it.
Grow the business for another year, and that number is bigger. And they agreed because they recognized that we had been growing the business. We had been hitting those milestones and metrics at 10%. We had been doing.
And they were on your board. They were watching you do this. Yeah,
exactly. And they watched our valuation consistently increase. So there was no reason for them to doubt that we would go out and do exactly what we said we were going to do. And so they absolutely signed off on that, and they never retraded on it. They were actually great great buyers and investors in the sense that they never actually retraded on that, regardless of what the macro market was doing. Our numbers remained good. We were continuing to grow our sales. We were continuing to do the things we needed to do. So even though the macro market was coming down, we were fulfilling our end of the pledge. They chose to continue to fulfill their end of the pledge.
So that was over the top of 2021 COVID tech boom. and 2022 early, and then the cracks started to show. And the end of 2023, 2022, things shut down, values, went away. And it's very typical when big companies acquire strategics that have a lot of control and, they're the logical end game and you don't have a lot of choice to retrade is renegotiate the deal. Oh, sorry. Those things in your financials, we don't like those. We're not going to pay as much, or we had a bad quarter. We're not going to pay as much, or something like that. But in the midst of all of that, they lived up to their deal. And on their side, they would say, this thing was growing. It's going to be worth more than 300 million. So regardless of the ups and downs of the stock market, did the business continue to grow as you predicted?
It did. The team that remained, to my knowledge, the business has continued to grow. The team, the universe changed. We had to move office spaces. There were a lot of changes that were made that I was happy not to be there and to be a part of that. And so, but as far as I know, they are still very happy with the purchase. And the team, a vast number of the team are still actually in the business, still working with that organization. So,
yeah. And that's the math. Why would a company pay more than 10 times your top line revenue? You had some profits, so it was way more than your 10 times your profit level, which is how most businesses are acquired, a multiple of profits. But why would a company pay more than 10 times in those days? Is because your growth rate is going, and you compound that a few hops, and it's towards $1 billion valuation if they do it right. And strategically, they ought to fit it in and make it more valuable right away inside a bigger family and all that stuff. Is that their thinking? And
that's exactly their thinking. They could bring sales and marketing resources. They bring the heft. They bring that customer access that we didn't have, and much easier for them to make this part of a bigger palette of items that they sell to their customer universe. And they make more money off of that feature function efficiency. And 100%, they're signing new customers regularly. They're able to, you can very clearly see the difference in the market now than before, where we were the upstart. And now very much the organization that we were is now very much an incumbent player in the market.
Okay. Well, isn't that funny to watch it turn into be the incumbent and so forth? And nobody asked Refinitiv and the London Stock Exchange, backed by the London Stock Exchange, to go get some VC funding so you're more credible at this point. With global
not at all at that point.
Okay. Well, what an amazing journey. Did your co-founder, Charles, stick around through the whole journey and partner with you, or, you stayed on the bus here? Did everybody stay on the bus?
Everybody stayed on the bus. Charles, again, left just before I left the business. I think the span was maybe 30 days, 45 days between us on that front. Mm-hmm. And we've remained great friends, and we're neighbors down at the beach. And we see each other.
You run out to the beach and high five each other. Just saying, I can't believe this, Look at you. And what happens in Raleigh and the Research Triangle, between the universities and the cities, Raleigh, Durham, North Carolina? There's a lot of tech there, biotech and banking and so forth here. Were you not a cool kid in the tech scene and then you became a cool kid, or is your story pretty well secret, as is most practical founder exits?
So the story most certainly was secret until it wasn't. And again, it goes back to something you brought up. It was always interesting just before the transaction, a number of VCs locally that came out of the woodwork and said, "Hey, could you give us the opportunity to invest somehow in the business?" And it was befuddling because it's like, why would I ever? You had your chance. But I'm a big fan of this community from a tech perspective. So our story is a story that we want other tech founders to recognize and realize that there are practical ways to grow a business and to achieve success without getting on, the venture go-go wheel. It doesn't mean that that's an absolute, but even if you have to get on that wheel, just recognize what you're doing there and make some smart moves to make sure you preserve your equity and your outcomes, your optionality.
Well, to sell a company you co-founded and invited some small investors in for $300 million, you're one of the wealthier people around, right? Way more than $50 million probably in this kind of thing. And the governor probably called and said, thanks for the tax check and other things like that. But I don't know, like you were a successful guy, you're well spoken, you built a valuable company, you faced off against the giants and won. Where did you start, Bill? Did you have humble beginnings or did you start at the top of the food chain or?
No, I started in rural North Carolina, a little town called Goldsboro. And my mom was a teacher. My father had been killed in Vietnam. I started, with an aperture that was much narrower than where I ended up at, in terms of outcomes.
Go to college, get a job.
Exactly. But, I had this support network, and I talk in terms of community and why community really matters. So in my community there in Goldsboro, I had an ROTC instructor, Colonel Haishu, who was a Vietnam POW pilot, who was an amazing person who had gotten captured, much like John McCain had been, tortured while captured, came out, he came back to this community, that community, gave back and taught me a lot about leadership and took us on trips and showed us the world through a different aperture, a different lens. I had a band instructor Angelo Holman, same type of individual, taught us a lot about the world and the community and how to do the right thing in life. And, all along the way, I had these communities. As I shifted communities, I found what I would call some of the best role models, best mentors, best people to help shape things. Here in this community, when I ended up back in North Carolina, I worked in the community, in the startup community. I watched companies like Red Hat and others actually, be born here and go through their growth and IPO cycles. And I got to learn from people like at one point in time, the president and CEO of Red Hat was a guy named Matthew Zulik. And he was a great operator. And one of the things I remember was anytime we were in an airport together, he would either be heading west or I would be heading west. We'd be crossing paths in Dallas. And we would actually spend time together in the club and just talk about business and life. And he made that kind of time for me. And there were people like that during that sort of education phase for me that were always very valuable. And I tell people, you cannot underestimate the value of your community when you're going through this journey. And that's just part of why I focus on community so much now.
Is it SAS, SAS
Yes.
Institute? Like the original bootstrapped, multi-billion-dollar success was a North Carolina company, proving you could do it without funding. An old school enterprise. That was the SAS Institute. Is that famous in North Carolina, presumably?
Without a doubt, it's very famous and very famous here in Raleigh. And, Dr. Goodnight and Jim Saul, the two founders of that organization, were amazing founders in terms of how they executed on the growth of their business, how they, eschewed venture capital, and they maintain control even through today in their business. And it's a multi-billion-dollar business. Yeah.
I wonder how much that company is worth. It's a multi-billion-dollar company, so maybe, it's the private company that hear about, right, out there, that kind of thing. So what an amazing story. And you're on the other side of it now. We talked a little bit about it earlier. You're investing and supporting your causes and traveling and having a nice life and all that. Do you have any thought of getting involved in yet another data play, right? Getting the band back together, as we say, doing that thing?
I am still enjoying this. As I like to tell people, I'm the old guy now, and it's a game for younger, for me, at least my perspective. And so I would absolutely support younger founders. And I do that already through a combination of investing and then also mentoring. And I support the notion of growing younger founders to do great things. And that's where my time and energy are now, not doing 80 hours a week to start another enterprise. It's tempting, and I get tempted regularly. Believe me. I look around and I was like, that's interesting. I think we could solve that problem. And heck, we didn't finish solving our business case with GDC. I think there's a lot more runway in that business model. And
that's funny.
easily could go back and do that again. But I'm actually having a great time doing the work
Yeah,
I'm
good for you.
doing. And it allows for me to also enjoy life a bit more.
Enjoy life. It's hard for some practical founders. So did you take a little therapy for you to get over the hump of, let's
Well,
say, climb the hill addiction?
yeah, there are probably people who would tell you I'm still in therapy around that.
Okay, yeah, good.
But, the therapy for me was not to start another business, to actually focus on giving back and focus on
Yeah,
other things that were important. Again, living life, giving
yeah.
back, and being more mindful. And that's where that therapy kicked in. And I read a great book years ago called Finish Big. And that book spoke about exits. And one of the biggest challenges founders have is on exit, if they don't have a plan, what happens then? It's generally messy if you don't have hobbies, if you don't have something else
Oh, well, yeah. No.
to gravitate towards, it gets messy for you. So, the family office second foundation really was the thing that allowed for me to make that transition a bit easier.
Transitional time. Yeah. Yeah.
Exactly. And because I had something else to then focus on.
Yeah. Well, that's whether you're VC funded or practical and you're growing, it's generally an all in if you're growing fast and you got a big prize there. And very rare that founders, at 100% growth are not going all in on their business. And a lot of practical founders, have good life balance along the way. But did you feel like you had life balance along the way or life along the way? Or were you say 80 hours a week doesn't give much left over for life? But
Yeah, well, it's great the way you reframe that, because I tell people, when people talk about
yeah, the B
work
word.
life balance, I
Yeah.
said there's no, it's not two opposite ends of the same coin. There's just life.
Yeah.
And, the balance is what you're doing at that point in time. So was it
Yeah.
great? No, there were nights I was waking up sweating. There
Of
were,
course.
there was a lot of things we didn't do that we could have been doing. But did I enjoy that journey? Absolutely. Would I go back and undo any parts of that journey? Very hard to say why I would do that, looking at the outcome and the outputs of the
Yeah.
success.
Yeah.
So I think that what I strive to do now is very much make sure I'm not working as much and that there is more, I'll call it, life to be lived. And so I do a lot of work around that.
Awesome. Well, Bill, thanks for sharing your story. It's amazing and the amazing journey that you had and outcome there. Timed it perfectly, I guess, here. Waited for your opportunity to rise, and then you went for it and you found opportunity to find a good home for it. What advice do you have for practical founders out there who are still in the desert and, thinking about someday the hope of finding the fit and getting that 10% a month growth? What is the most common advice you have for those founders these days that are thinking about making the turn to a sustainable business?
So I will say the number one thing on that, easy for me to actually answer that question, is
Okay.
because Randy Komisar, a noted angel investor and founder himself out west, has sort of answered that for me. Always know your why.
Mm.
Understand and know why you are doing what you are doing, because that why is going to be the thing that sustains you through those hard times, those
Hmm.
challenges to your business model. When other
Hmm.
people are saying, no, 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 you shouldn't be doing this,
Yeah.
you understand your why. And as long as you understand your why, then you work towards figuring it out. And it doesn't mean that you will always figure it out. I do talk to
Yeah.
founders regularly who end up having to, shut down. But it's not because they don't understand their why. It's just because things didn't work out, the macroeconomic
Hmm.
environment, whatever. It
Yeah.
doesn't always work out. In fact, most of the time, it does not work
All the
out.
time.
But as long as you know your why, the rest then is just part of the journey for achievement of that why.
Isn't that amazing? All the work and all the challenges and all the crises and all the night sweats and everything. Founders get to the end of it with a why, as you're saying, and say, boy, that was fun. You do that funny?
It, it's,
Uh,
it's amazing. But if you step back and think about the business I built involved international travel, international data, and people. The things I most enjoy: international travel, interesting people, yeah, and data. Yeah.
People in data. Yeah. Yeah. You're a strange one, Bill. The people in data side, you love those things. I love it. And you used your superpowers for good. So you weren't a villain in this.
I was not pulling a Lex Luthor in this exercise.
Yeah. Excellent. Well, Bill, thanks for sharing your story on the Practical Founders podcast and some of the insights that you managed to discover along the way.
Absolutely. Thanks, Greg, for having me here today. Appreciate it.
Thanks. Thanks for watching this week's founder interview on the Practical Founders podcast. Be sure to hit like and then subscribe to my Practical Founders YouTube channel to keep up with my weekly videos for serious software founders who are building valuable companies without big funding. Check out my blog and information about my Practical Founders CEO peer groups at practicalfounders.com. And follow me on LinkedIn to keep the conversation going. See you next week.